Welcome back. Today we're going to talk about wealth building. In the last podcast, we talked about the 7 levers of cash and how to really increase cash and profitability in your business. Hey, what do we do? Like, now we have cash. What do we do with it?
Well, that's where I like to talk a lot about how to invest in certain things that are not only good for now or good for later, but good for both, right? So we're looking for things that are going
Now
to...
and later. Yummy.
One of the things I know you like to talk about is the hit by a bus test, right? And that's for your business in particular. Like, if you were hit by a bus, would your business even survive? Can the business operate without you? We're talking about growing a business and growing it in such a way that if that is the case, you are hit by a bus, that, hey, look, the business keeps going. The business can go to your family and they can, either learn how to operate it, or it operates in such a way that it's saleable to either the next inline management or saleable to another party, and it's still valuable. Now we want to bring that test home, not only for the business, but what happens if you're hit by a bus now, tomorrow, and you've already sold your business, and so there's no more money coming in the door. What is your family going to do? Is there enough of a legacy there to continue on?
Yeah.
And so we can talk about a lot of different ways. Going back to just how most of us grew up, we were taught a very specific way, right? We were taught to get good grades, to go to college, to get a degree, to get a job, to get a promotion, invest in our 401k, and hope that we've saved enough by the end of our lives.
Maybe one day
that we can actually retire and have enough money to carry us between our 401k. We are in a generation where Social Security is no guarantee.
Oh, no guarantee. I think it's pretty much a guarantee it's not going to be around. It's going to be a fun bill we got to pay during our biggest.
Then it's the 401k, right? Have we put enough money away? You can max it out every year. Is that enough? How much is enough in that account? Well, that number changes yearly based on inflation, based on costs of living. And where I think a while back, if you had $1 million saved, that seemed like a good amount that you can actually retire and spend the last 20 years of your life. No, and I think that number right now is probably closer to 5-6 million.
Yeah.
The generation of our parents, or maybe older in some cases, the generation of pensions, where companies offered these wonderful things called pensions, where you could retire and we're just going to keep paying you until you die.
Yeah, my dad has one of those, and he's like the last though, and he was a government employee. They had a really good pension. It came out with this new program, and they offered it to him, and he was like, no. And that was the smartest decision he ever made, because those people, he gets a paycheck, and he actually has survivor benefits, so he gets a paycheck until my parents get a paycheck until both of them pass. Yeah. That's amazing.
Well, then my dad's mailman, pension. My mom worked for the schools, pension. A lot of people, a lot of business owners in particular, and definitely service-based business owners, see a ceiling. They're like, right, there's, I can be super successful. I can make a lot of money. I can put some money away into an IRA or a Roth IRA or a self-directed IRA. And that's all well and good, but it seems like there's just a cap. Like, you can't hit that next level. Well, it's about knowing some of the things that are out there that exist. Most of us who didn't grow up in white-collar families, talking about getting into some alternative investments. I'm not talking about crypto. That's out there. I'm talking more about investments into commercial real estate, investments into business acquisition, lots of investments into larger scale investment pools that allow you to actually participate in something much larger than you would be able to do on your own.
Yeah. Okay, so the big thing that I hear everyone talking about when I go to these conferences with him, they're always like, multifamily syndication. Okay, for the longest time, I was like, yeah, it's cool. I had no idea what it was. Is multifamily syndication, and why do I care, and why is it cool?
So yeah, let's talk about that. That's probably the most common, the most popular, multifamily syndication. What is multifamily? It's apartments, right? Apartments, apartment buildings, apartment complexes, apartment developments.
Like the big ones.
The big ones. Trying to buy these 50, 100, 200, 500 unit apartment buildings, apartment complexes. As an individual, okay, there's a price tag on this thing. If you got a small one, maybe a 10 unit, you might be able to, depending on the market you're in, let's call it a couple $1 million. You may be able to see yourself one day being able to buy something like that. But then, what do you do with it? I mean, if you're you or I...
then you have to manage it.
Yeah, then we don't know anything about it, right? Okay, well, then maybe you hire a property manager. They can help you out. But then now you're getting into this whole, okay, well, now this is another job. A syndication allows you to participate in purchasing one of these large scale, and we're talking, 50, 100 unit plus buildings where maybe the price tag on that is 10 million, maybe it's 20, maybe it's 50. So how do you participate that as an individual person? Well, that's where the syndication part comes in. Syndications are basically pools of investors. You have operators, who are the people who understand these apartment buildings very well, how to run them, how to manage them, how to reduce expenses, a lot like you run in any other business. The goal when they're purchasing these, especially when you're trying to add value, is you're going to purchase it, you're going to find this building in a great market. You're going to find one that maybe hasn't been managed as efficiently as it could. Maybe they're paying too much on their expenses and you can find ways to reduce that. Maybe they just haven't kept up in raising rents to what the area justifies paying in rent.
They're going to look at their 7 levers of cash.
And it's exactly, it's the same thing.
7 levers. Yeah, pricing, expenses, volume.
This is exactly right. And so you're finding these guys who know this market, who know how to do this very well. And these guys are great at that. But they don't have $50 million either. So what can they do? They can create a syndication. What a syndication does is you have your general partners, who are the guys who are going to operate. They have a plan to buy this real estate, to improve it, to reduce costs, to increase the value. Apartment buildings, commercial real estate is valued not like your house. Your house is based on how much the house next door to you sold, how much the houses in your neighborhood most recently sold for. That's how real estate is typically evaluated. Commercial real estate is valued based on the operating. It's valued like a business.
Yeah.
You increase the value by lowering expenses and increasing
Profit
revenue.
margins.
Exactly. The plan is these operators can come together. They usually have a team who specialize in certain areas. They identify, hey, this property is at a great price right now. We can buy it for X amount. We can carry it for 2, 3, 4, 5 years, improve it, and then sell it for a profit down the line. What they need is capital. They can get a loan for part of it, but they need capital for down payment. They need earnest money. They need money to actually make the improvements to the property that they want to make. They need additional costs just for carrying that property while they bring it up to the value that it needs to be at. They're going to raise additional money for reserves, just in case money. It's unlikely that they're going to find that source of money in one party.
Yeah.
So what do? They go to groups and they say, hey, we are looking to raise, $2 million so that we can purchase this. And they ask for contributions from typically accredited investors.
Okay. So now you have to explain what the heck is an accredited investor.
So an accredited investor is somebody who's going to make a certain amount of money for an individual. It's going to be $200,000 over the last 2 years. Each year.
Okay.
For each of the last 2 years. Or if it's a married couple, $300,000 for the last 2 years. Or the other criteria could be a net worth of $1 million.
Okay.
Achievable for some of the people we're talking to, but what they don't realize for
your
a lot of the guys,
business is part of your net worth.
Your business is part of your net worth. Your primary residence is not. The house you live in is not considered a factor in your net worth for this particular calculation.
Yeah.
It might be worth $1 million and you don't even realize that you are an accredited investor. And typically people in my space who go out and they try to help raise capital for these deals, they're out there, they're looking at doctors, they're looking at lawyers, they're looking at pilots, they're looking at all these people who make great money who are very white collar people. One of the things we realized as we started working through this process, dealing with the clients that Sheena's dealt with, is there are a lot of blue collar business owners. There are a lot of plumbers and landscapers and roofers and electricians who are accredited investors.
Oh, yeah.
Don't even know what it means. Nobody's talking to them. And this is
Wouldn't you want to buy an apartment building? That sounds pretty fun. I want to buy an apartment building.
The great part about it is if you're an accredited investor, these guys are going to say, hey, look, we're looking, our minimum contribution may be $50,000. You got $50,000. I know a lot of you were creating really successful businesses. At the end of the year, you have to spend some money if you don't want to pay a huge tax bill.
Yes. Oh, yeah. With some of my clients, I'm like, okay, are you ready for your shopping spree?
And a lot of times it's right. Let's go out and buy some equipment. Let's go out. But what if you were able to take some of that and say, well, I've got this money. What if you could put $50K of it into this deal? And now that money gets to make money for you. Now, the way that these payouts typically work is there's, some sort of a preferred return, meaning any investor who invested in this property, you have to do zero work. You're what's called a passive investor in this deal. Your job is to just contribute money and collect returns, ideally. Depending on the deal, the profits are going to look different. You may not make much in the first couple years, but at the end, you're going to make more money.
But it's the same kind of thing as investing in the market, right? You're not expecting to take out that money in 2 years. A lot of times when people are investing, they're investing for the long term. So this is the same kind of thing, but it's investing in real estate, and it's investing maybe like bigger chunks of money, and there's a lot of the tax benefits and things like that,
right,
that don't necessarily come with all of the traditional investment vehicles.
So we can go through just kind of a very hypothetical example. Let's say, the preferred return on a deal is 8%. What that means is anybody who invested gets ideally the first 8% of profit that deal makes goes to the investors. That means the people operating the deal may not even make money that first year or two, especially when they're really digging in and doing all the work to make this more valuable. A lot of times they're not making a ton of money. There may be some admin fees that that kind of keep them afloat, but they really make their money based on making this asset perform, this asset being the apartment building or complex, making it perform according to their plan.
Yeah.
All of their money is made by not only meeting the goals that they set, but exceeding them. Because that first 8% goes to the investors. And then anything above that, there may be what's called a waterfall, where it's maybe a 70-30 split then, where 70% of the additional profits goes to the investors, and that extra 30% goes back to the partners.
Yeah, but the nice thing with that too is that it's kind of like a team.
Right.
Where, these people that you're investing in this deal, your success is their success, or their success is your success. You're working together.
Yeah.
Like they will never actually realize the money that they want to make if they don't perform to what they said. So, it's pretty good.
Yeah.
No control over this, the share price of a company, and you have no tie together at all. So at least this, you feel like more of a team. Plus, it really gets your money working for you instead of you always working for your money. If you work hard for your money, it should work as hard for you.
Yeah, and I think over time, if you invest in like the S&P 500, I think the steady growth of the S&P over historically is about 8%. You're still making that same amount, but if it overperforms, now you're collecting additional money. And where it really gets good is at the end. Now you've made this big improvement, and say the building when you bought it was worth $2 million, and you've improved it, and now you're able to sell this building for $4 million. Well, guess what? That's a huge profit. You pay off all the loans that were due, and now you have this big chunk of money that goes out, split between the partners, and 70% goes to the investors. Well, if that's $2 million of additional profit on top, 70% of that is $1.4 million that then goes out to all the investors. So now if you take over the course of that 5 years or 3 years that you held that property, and you say, okay, wow, well, not only did I make my 8% a year, I got this huge chunk of money at the end, and you average that out backwards over the course of that deal. Now your return rate over that 4 or 5 year period may be 15, 16, 17%, which is way above what the market would produce.
And this is definitely a long-term strategy, but at the same token, it is also backed by real estate. So there is like kind of hedging of your bet there. Right. Not completely, obviously, but a little bit.
This is just one part of the benefit of this strategy. There's also a lot of tax benefits that can be passed through to the investors. One of the biggest tax breaks that you can get is depreciation. A lot of times if you have equipment in a business, you get a tax write-off for the depreciation of that equipment over time. Well, now you're talking about depreciation of a huge asset, a huge apartment building that depreciates over time. Those tax benefits can be passed through to the investors. This is all case by case, deal by deal, but this is another huge benefit. You could not only be making these returns, but you could be writing off such a large percentage of it that you're paying little to no taxes during that time frame, which is incredible. And this is where it really starts to snowball. A lot of people say, okay, you want to diversify where you invest your money, right? You should have some in stocks. You should have some in your 401k, which is also going to go to stocks. But a lot of people want diversification. You can diversify within real estate. We've talked about one avenue, multifamily. And even if you only wanted to invest in apartments, you can invest in different markets. There's different markets. There's different classes of apartment buildings. That means that this building is prime. It's already great. Rents are already great. This thing's going to bring in money. It's going to churn money. You're not going to get as good of a return, but there's going to be very little improvements that need to be made. This thing is made to make money risk. As is. It's a lot lower risk. If you're talking about adding value, there's going to be more of your B or C class apartment buildings where they're looking at it and perhaps it's a small owner and they just couldn't kind of keep up with the times. One of the concerns people have, they're saying, well, if you're going to raise rents on people, aren't they going to move out? But the thought process is you're raising rents to the amount that the rest of the market is.
Yeah.
You're doing it slowly over time.
Or you're improving it. And so then you're raising rent because you just made it nicer, right?
You're both.
Adding amenities. So then we can raise the rents. It's the same kind of thing we were talking about last time with pricing. We have to have a pricing strategy, right? It's not just, oh, this person said maybe I should charge this much.
Right.
That doesn't work.
Yeah. I mean, there's a whole plan in place to say, okay, here's what we can come in. Here's how we can improve it. We're going to put up additional lights in the parking lot, make it a little safer. We're going to put up surveillance cameras. We're going to look at ways to make it more efficient. Maybe you add fiber optic to the building or something. There's lots of different ways to add revenue that actually benefit the tenants. And when you're talking about raising rents, like we said, you're raising them slowly over the course of that period, and you're raising them to market rent. You come in, you live in this apartment, and you know that it's priced maybe $200-$300 less a month than it should be. Okay, well now they're coming in and you're like, oh great, they're going to come in, they're going to raise rents, but you see they're improving things, they're redoing the pool, they're making things nicer. And then you start shopping around, well, I don't know if I want to pay that much. You start shopping around and all the other apartments in the same area are the same price.
Yeah.
Would you rather stay at the place that they're improving and just pay the same amount that you would pay by moving, and then you don't have to move?
I hate moving.
There's a lot of benefit. You're trying to improve the living situation. You're trying to increase decrease the vacancy. You want your building as occupied as possible. You want to provide a good experience so people want to live there.
Yeah. Well, I think it's great too, and it's good for the community. Nicer places are better for the community. Like all these different things, the investors make money, so everybody wins.
Everybody wins.
And I love it too because it, we were talking about business owners and how they're probably accredited investors and they don't know it. I think one of the biggest takeaways we want you to have from this mini podcast series is that if you're just starting out and you're trying to get there with your business, don't worry, we got your back. Maybe I'm an accredited investor. I don't know. We would really love you to reach out to the bluecollarwealthclub.com. Has all of our information on how to connect with us and see if you're an accredited investor. And if you are, then we can talk about ways to invest. And if you're not, then we can talk about ways to get you there. Because the whole point is getting you to that point to then be able to invest your money, whether it's with us or somebody else, to be able to have your money working for you instead of you just working for your money.
Absolutely. I think when we started this whole process, we started talking about some of Sheena's clients and who we wanted to serve and who we felt most drawn to. Realized that there's a whole world of people, all of the backbone of this country, who works very hard every day, just as deserving of having the type of success that white collar workers have. They deserve the same type of financial freedom. They deserve to have more time with their families, to be able to retire, to take their families on these great vacations. And you should be able to have that life. Don't let anybody ever tell you you're just a plumber. You're not going to be able to do that. We have taken a lot of offense on your behalf.
Yeah, there's no such thing as just A.
Exactly.
And I always joke around that the one thing AI will never replace is service professionals.
Yeah, we feel very strongly that there's a whole deserving group of people out there who aren't being spoken to about these types of things, and we really want to help grow and strengthen that middle America that seems to be weakening over the last 10 years, build it back up and build it stronger, participate in all the things that the wealthy already know.
Exactly. Yeah, they're investing in apartment buildings, so you should too.
Absolutely. That's just the tip of the iceberg. Like I said, there's a lot more investment strategies. We will get into lots more of this. Hopefully join our podcast, subscribe, and learn much more than you ever thought was really out there.
Yeah.
A lot of stuff.
So head on over to bluecollarwealthclub.com and connect with us. And we can't wait to chat with you on your journey to financial freedom and wealth.
Yes. Thanks for joining the series. Hope you got a lot out of it, and we will be talking to you a lot more.
Bye.